It happened quietly. At 2:47 a.m. Beijing time, a classified directive landed in the inboxes of China's largest exporters. 4 words: cease dollar transactions immediately. No explanation, no press release, no warning. Just a digital whisper that traveled like shockwaves through the arteries of global finance. By the time the sun rose over Shanghai, bond yields were surging, Wall Street was bracing, and trading terminals from London to Singapore were flashing red. Within hours, the financial world tilted on its axis, not from a missile or a tweet, but from a silent, calculated strike. And now, one question is ricocheting across trading floors, boardrooms, and sovereign desks alike. Is this how the US dollar loses its throne? Not in a blaze of confrontation, but in the cool quiet of strategy? In April 2025, China's Ministry of Commerce quietly issued an order to over 400 state-owned and private firms. Effective immediately, they were to halt all new payments settled in US dollars. The directive, confirmed by a leak verified by the South China Morning Post, was labeled non-negotiable. It wasn't a mere accounting change. It was a rupture, deliberate and decisive. The response was swift. Within 72 hours, Bloomberg reported a 12.4% drop in dollar-denominated settlement volumes from China. ING analysts called it the clearest signal yet that Beijing is not just testing de-dollarization, it's institutionalizing it. For years, China has spoken softly about reducing reliance on the dollar. This time it moved. But why now? And why so silently? To understand the timing, you have to follow the numbers. The yuan's share in global trade finance jumped from just 4.5% in mid-2023 to 7.6% by March 2025. SWIFT data, once seen as an indicator of organic market demand, now reads like a report card for an engineered campaign. China's ambitions are no longer theoretical. The architecture is being built, and the pipeline is flowing. The digital yuan, once a concept floated by the People's Bank of China, now processes over $250 billion annually, both domestically and across borders. And it's not just about faster payments. It's about control. It's about traceability. It's about sovereignty. China is no longer trying to join the existing global financial system. It's building a parallel one. The fallout in the West was immediate and fierce. Within 48 hours of the directive, U.S. Treasury yields spiked. The 10-year note surged 38 basis points, closing at 5.09%, the highest since before the 2008 financial crisis. J.P. Morgan estimated over $212 billion in Treasuries were dumped in 4 trading days. Much of the selling was traced back to sovereign wealth funds and Asian institutional investors, some of which had been quietly offloading for months. The People's Bank of China had already reduced its U.S. debt holdings from $859 billion in January to $729 billion by March, according to U.S. Treasury data. But what had been a gradual trend suddenly looked like an orchestrated pivot. Mohammed El-Erian, chief economic advisor at Allianz, went on CNBC warning, "This isn't just a yield spike, it's a regime shift. The global cost of capital may never be the same." The U.S. bond market trembled. Volatility surged to levels unseen since the COVID-era panic of March 2020. But unlike that moment, this wasn't driven by fear. It was driven by intent. Beijing wasn't reacting, it was leading. And it wasn't alone. Across the BRICS bloc and even within parts of the G7, cracks in the dollar's armor are becoming fault lines. Former IMF official Eswar Prasad put it bluntly in a Wall Street Journal interview. "We're not just watching diversification, we're witnessing decoupling." In March, the yuan overtook the dollar in China's cross-border trade settlements for the first time in recorded history, accounting for 48% of transactions. And on April 18th, Saudi Aramco confirmed its first full oil shipment to India was settled entirely in yuan. Not a single dollar involved. Reuters broke the story. Wall Street barely slept that night. Reserve currency status doesn't end with an explosion. It erodes transaction by transaction, deal by deal. And that's exactly what's happening. So what's replacing SWIFT, and why should Washington be worried? While the U.S. relies on a global payment system built in the 1970s, China is quietly rolling out a modern alternative. It's called MBridge, a blockchain-based settlement platform co-developed with the UAE, Thailand, and the Bank for International Settlements. In March, it completed a live pilot, clearing $23 million in real-time cross-border trades, completely outside the U.S. dollar's reach. Anna Naran, HSBC's Asia head of digital infrastructure, told Bloomberg, "MBridge doesn't just make dollar intermediaries obsolete, it renders them unnecessary." Meanwhile, as Congress debates the design and rollout of a U.S. central bank digital currency, China's digital yuan is live, it's scaled, and it's growing. It's already being used in energy trades, manufacturing contracts, and regional lending initiatives. This isn't science fiction. It's happening now. And while Beijing expands an entirely new financial bloodstream, Washington's response so far has been reactive. Monetary band-aids on a system losing leverage by the quarter. Markets are still adjusting. The Federal Reserve has hinted at tightening liquidity support. The Treasury is scrambling to reassure primary dealers. But behind the scenes, global capital is watching, calculating, and asking the unthinkable. What happens if the world no longer needs dollars to trade? This wasn't panic. It was precision. And if this is only the opening move, what does checkmate look like? Trump didn't mince words. On April 19th, he posted on Truth Social, "Cut rates now or we risk total collapse within hours." That wasn't just political theater. It sent a message straight to the Fed. Within days, the dollar took a nosedive. The index fell from 104.3 to 98.7, the sharpest weekly drop since the 2009 crisis. Capital didn't wait to react. $76 billion fled U.S. markets in just 1 week, much of it from foreign governments and corporates hedging against a falling greenback. Here's the catch. Lower rates might keep credit moving, but they also rattle global faith in the dollar's future. Mohammed El-Erian spelled it out. Cheapening the dollar only speeds up the rush into gold, commodities, and currencies like the Yuan. And the data backs it up. For the first time in 40 years, the dollar's losing ground simultaneously to China's Yuan, Japan's yen, and Russia's ruble. Meanwhile, China's playing a longer, quieter game. In Q1 of 2025, 128 countries traded more with Beijing than with Washington. That list now includes Germany, Australia, South Korea, even the UAE. Chinese exports jumped nearly 9% year over year, while U.S. exports fell by over 3%. Why? China's out there closing trade deals across Asia, Africa, and Latin America. The U.S.? Still clinging to trade agreements from 5 years ago. Adam Tooze put it bluntly. Trade today isn't just about markets, it's about alliances. And more countries are pivoting east. If the flow of goods tells one story, the flow of capital tells the next. The U.S. economy shrank 0.7% in Q1, technically a recession, but zoom in and it looks worse. Real wages are down. Credit defaults are rising. Small business bankruptcies are up nearly 20%. And mortgage delinquencies just spiked, again. Freddie Mac is flashing red. Morgan Stanley says there's a 40% chance of a technical depression by year end. The Fed is stuck. Raise rates and housing collapses. Cut them and the dollar bleeds. Monetary policy is no longer a domestic lever. It's a global weapon. And right now it's misfiring. Manufacturing's tanking. The ISM index just hit its lowest point since the early pandemic. Export orders are collapsing. West Coast ports? Traffic is down 27% year over year. Boeing alone lost over $14 billion in orders last quarter, double the previous one. U.S. manufacturers are losing Chinese suppliers, while trade insurers are slashing credit exposure to American exporters. But maybe the deeper threat isn't China. Maybe it's Washington itself. In the first 4 months of 2025, the U.S. added $1.3 trillion to its deficit. Not from stimulus, but from basic obligations, entitlements, interest, and monetary patches. And foreign buyers are stepping back. Central bank holdings of U.S. Treasuries have dropped to just 38.6% of total issuance. Japan and Belgium cut their U.S. debt exposure by double digits. Even Saudi Arabia, America's longtime partner, is pulling back. El-Erian's warning hits harder now. Confidence erodes quietly through fiscal chaos and political weaponization of economics. The U.S. didn't just lose buyers, it drove them away. So here we are. China's cutting the dollar cord. The U.S. is fraying it from within. The world's not just drifting from the dollar. It's preparing for life after it. And if that shift accelerates, from currency swap lines to reserve realignments, the impact won't stop at bond markets. It'll hit pensions, prices, paychecks. But here's the question no one's asking. What if this isn't collapse? What if it's a pivot, a prelude to a deeper reset? The end of the dollar era might not be loud. It might just slip away, quietly, while we argue over rate cuts.